with us. Thank you for coming back from morning tea. I hope you all got some refreshments and you're ready to go for this next session because it's going to be a good one. We're diving into the world of financing. In this session, we are going to hear from Hanah Ebling and Tom Dawkins. Hanah is CEO at Sefa, working with social purpose organizations on capital solutions and capability uplift to suit their needs, helping these organizations build resilience finance from a range of impact investors, from traditional banking with HSBC to venture philanthropy in the Philippines. Hanah brings a global practice lens to Sefa. Hanah will be joined by Tom. Tom is a serial social entrepreneur with a passion for using technology and entrepreneurship to build a better world. Tom co-founded StartSomeGood, an innovation agency and global social enterprise ecosystem builder in 2011 while living in San Francisco. He was CEO until March 2024 when StartSomeGood was acquired by General Good. Tom is also the co-founder and chief impact officer of LendForGood, a platform that connects social enterprises with impact investors. Please join me now in giving a very warm welcome to Hanah and Tom.
Verb testing. Excellent.
Does this work? No.
No, we're good. We're both on.
Yeah.
Well, great to be here. Thanks for choosing this session, guys. I do just want to, before we go any further, reassure everyone that you don't, in fact, have to sit in the same seat every time. So just because you might have been pushed to the edges during the plenary when everyone was here doesn't mean you couldn't, for instance, sit with Andrea here, who's lovely, at this table at the front. So heads up to everyone. But thank you for joining us today. Just before we go any further, just acknowledging quickly that we're meeting on Gadigal land. Yeah, and pay my respects to elders past, present, and emerging, and acknowledge that this land was never ceded. We're going to go through a couple of quick things to kind of set the context of what we're going to explore. Our focus here is on debt investment and how debt investment can help social enterprises grow and thrive and make more impact. But before we dive into the specifics, am I coming in and out as badly for you as it sounds to me? Yeah. Is there anything we can do about that? Okay, but if I'm just in and out on the recording, that's no good for the people in the room or for the recording, I suspect. Anyway, so I want to give a quick context in terms of the impact investment ecosystem and market overall. I think a lot of social enterprises in particular come in with a lot of confusion as to what's really happening. When people talk about impact investing ecosystem, they tend to map out something that is quite conceptual. Here are the different types of impact investment. Here's concessionary, here's impact first investment, here's finance first investment. But that's largely a conceptual map. It doesn't necessarily tell you who's actually doing what and what type of capital is available in the market. And so the problem that my new enterprise, LendForGood, set out to solve is something called the missing middle impact investment. To put that into more conventional startup terms, you can think of that as the angel investment gap. And that's the challenge of raising between about $50,000 and $1 million, not just in Australia, but globally. When I started StartSomeGood 13 years ago, did so because it felt like no one was helping people at the very beginning. There was a lack of support for people with brand new ideas to kind of turn that inspiration into a real model, to raise the first funds so that they could try that model out and then hopefully succeed and scale it if it was working. 13 years later, there's now a lot of support at the very beginning. There's lots of great programs out there, fellowships. Every university has some sort of a pathway towards entrepreneurship for students and alumni. There's some grants, there's some fellowships. There's traditional kind of community crowdfunding such as StartSomeGood has supported, where most people with some hustle and a reasonable idea should be able to find the first $50,000. Now the gap is that next stage. Once something has been proven, you're out there in the market, you've done a few things, where's that next capital coming from? And that missing middle gap is an artifact of a couple of things. And it overlays, it's different from, but overlays with the second big gap in our ecosystem, which is which is kind of the range of returns gap, what they call the lack of concessionary capital. So almost all the market that does exist in the ecosystem is targeted at a later stage, and almost all of it is seeking traditional commercial returns plus impact. That's going to exclude instantly most of the social enterprises in this room, whose models either are not appropriate for promising commercial style returns to investors, or who are not yet at the stage where they can be ready. And so one of the things that can drive you a bit crazy in the impact investment ecosystem is that everything we need is here. We have all these incredible companies with genuine solutions to social and environmental challenges that are scalable and could make a much bigger difference. At the same time, we have an enormous amount of capital that has been put aside to support impact. $1.2 trillion invested in impact investment funds last year. But there's now over $3 trillion sitting in those funds. And so what does that tell you? That the money has not actually been invested in impact. It's been invested into impact investing, but not invested into impact. And it's sitting inside those impact investing funds. And the reason for that is because they can't find, they want to make bigger deals, they want to make commercial deals, and there simply aren't enough of those in the marketplace. So even though everything is there, no one's getting what they need. The companies can't find the capital they need, the funds largely can't find the deal flow they need. And so there's a few reasons why that emerges, which can't get into too much detail, but that's kind of the shape of the market right now. And as you're thinking about moving into impact investment, it's important to be realistic about, it's not to say it's impossible, to be clear. I'm not saying that none of those other types, in that there are no impact angels, that no one is doing concessionary, that the examples do exist, but they're pretty scarce on the ground, which naturally means it's highly competitive to find them, and people tend to have to put a lot of work and effort or get very lucky with the people they meet and the relationships they're able to form who have a strong connection to what they're looking for. And that's particularly true depending on your model. If you're structured as a for-profit, that's even harder, because where more supportive capital does exist, there's more of it on the philanthropic side at the moment than the genuine return-seeking investment side in this middle stage. So I'll pause there and see, and Hanah's going to talk a little bit more about the work of Sefa and how they think about debt as an instrument of investment.
Well, thank you very much, Tom, for setting the scene. So I'll really bring the practitioner lens of being a lender to a range of social purpose-driven organizations into the conversation. And so obviously we do play in the missing middle, but when Sefa was set up about 13 years ago, our purpose was really to fill that gap between philanthropy and the mainstream banks. So we provide a range of highly customized debt products to organizations that actually want to take on repayable capital and explore that as a way to either A, stabilize, or B, grow their organization to really truly unlock their potential for impact. And I think what we've learned in the 13 years during which we're getting close to dispersing about $50 million from our $20 million balance sheet. So there has been a lot of recycling going on. So people have actually repaid us, which I guess is a good thing if you're a lender. And we are getting, close to 75 loans out of the door. And we've only ever written off one loan. So starting with that, and I think another interesting fact is that actually over 40% of our borrowers have made early repayments. I think lands me in the space what we are hearing a lot around demystifying debt. A lot of people think debt is a dirty word, and I would actually like to, start the conversation. If anybody, words that come to mind when you hear debt, when you as a founder on your organization or as a director, of a not-for-profit, if you think about debt, like what is the connotation that you have with it? Something. Risk. Pardon? Cost, absolutely, spot on. Growth, oh, that's interesting. But the first two, absolutely, in terms of risk, this notion of, it's a burden, it's an obligation. Yes, it's repayable capital. The cost attached to it, it's expensive. Growth, it's an interesting one because obviously, a lot of people think you need grants to grow or equity, something there's no obligation to repay. But this notion of that it is costly, obligation, repayable, a lot of people actually disregard debt as what we think from Sefa's perspective really as a practical tool to actually, dive under the hood of your organization. So what Tom and I will do now, a little bit as, I'm playing obviously the lender role. Tom has currently agreed to take the enterprise hat on to really unpack some of that. What does it actually take on debt? And the two phases that we will really focus on is how do you think about debt when you actually want to get investment ready and you want to explore debt as one of the options of capital? And what does it actually do to your business once you've taken on debt capital? Because certainly from my personal perspective, everybody is so focused on this moment in time when they get the check or the bank transfer and money lands in their bank account, that they forget about all the value that is in there in the journey of taking on capital. And obviously from our perspective, it's primarily debt, and then also later on making capital work. So maybe we start with that notion of like the curiosity around exploring capital. What does that mean to social purpose organizations? What are some of the common misconceptions and questions, I guess, that come up?
Yeah, and I think you need to fix your collar on the left side. I don't know about the rest of you, but your asymmetry is kind of messing with me a little bit.
Got it.
On
Okay.
behalf of anyone else in the room. Also for the photos, that guy's photographing you a lot from that side, and it's going to be blocking your profile. Looking out for you. So I did want to say a couple of things just generally, because I do think that a lot of founders have a very confused relationship about debt. And I speak about this, yeah, zhuzh her. And I speak about this, you know, as myself, because I had a very confused relationship about debt in terms of the funding of my companies and my enterprises. Because I came from, you know, the first 15 years of my career, I'd founded a number of nonprofits, and I'd been in the nonprofit world the whole time. And then I moved into StartSomeGood, was my first for-profit social enterprise that I've been part of. And equity to me felt a lot like magic beans. I'd founded multiple organizations before, and when you found a nonprofit, you got nothing whatsoever other than your ability to convince people that the mission is something they want to be part of. But then I founded this for-profit, and I discovered I had this thing, this ineffable asset all of a sudden. Just, I founded it yesterday, and today I have an asset that I didn't have when I founded nonprofits. And I discovered that some people were interested in that asset. I'm like, this is cool. I'm like, I'll give you a little bit, and I'll give you a little bit. And I just kind of splashed it around as this cool thing that I could exchange for labor and support. Not realizing how expensive long-term not managing your equity really is. And I think for a lot of people, debt is the reverse. We think of it as very risky and expensive when in fact it's cheaper and less, looked at from a different point of view, it's much cheaper and less expensive than equity. But it's hard to get your head around if your background is grants. The idea that someone is investing in your organization, but they want all the money back. And actually, they don't just want all the money back. They want more money back than they put in the first place. You're like, what kind of support is this? This is insane. You're asking me to support you, basically. Whereas equity can feel a bit grant-like. They don't want any money back. There's no repay. It's often not linked to a specific program of work or deliverables. It's just build the company. Hey, that's awesome. That's the best kind of money. But then you discover you can never get rid of them. And that whoever you handed out like little fractions of equity to at the beginning is like stuck with you for the rest of your life potentially, and that can have all sorts of challenges later on. And so I think it's, you know, I think we often just transfer our personal feelings about debt onto the company. I don't like debt. I got too much credit card getting my debt in my 20s, worked hard to get out of it, cut up my credit cards, and have not been in debt again. And I personally don't want to be in debt, but you know, the ability to kind of separate that from what's actually strategic for the company, I think, is really important. And there's a reason we chose debt. People ask me a lot why we don't do equity on LendForGood, and there's a couple of key reasons. One is that it's a universal instrument for social enterprises. As I'm sure you all know, our sector is a mishmash of different legal structures. And some of the most interesting and fast-growing and commercially minded social enterprises in our sector are in fact structured as charities, like Humanitix say. They can't do equity investment or thank you group. Ditto with cooperatives. You know, at the moment we have like philanthropy can support the nonprofits, impact investment in theory should be investing in the for-profits. Neither of them support cooperatives. Indigenous organizations are often committed to maintaining 100% Indigenous ownership, which makes the number of equity investments they could work with very, you know, very narrow. Equally, from the lender point of view, I believe it's a democratizing instrument, because to do equity investment, you really need to have money that you can afford to never see again. You shouldn't make early stage startup investments with money you need at any point. It's got to be play money, upside money. Whereas lending, it's just money you don't need now. Now, obviously, you need to be mindful if it's money you have pegged for a purpose later on. Obviously, you want to be mindful about any kind of risks and so on. But this is, in fact, what's happening with your money. When you put it in the bank, it doesn't sit there. They lend it. They lend 20 times more than that, actually. They leverage it. So they're keeping the financial upside of your money, and they're also deciding what economic activity is supported with your money. And you get neither the upside nor the influence over where that goes. And so we think that's an interesting tool that can enable all of us playing with smaller amounts of money, but that's what's needed actually in the ecosystem, is not large chunks of money. We need small investments to unlock the potential future large investments out of those big funds. But a lot of people don't know when the right stage is. So I guess that's what we're going to think through a little bit. because there's different stages where different types of investment make sense. You know, right at the beginning with nothing proven, I do think there's a really important role for philanthropy to help fund experiments essentially and trying new things. When a commercial model begins to emerge, but is still unproven and high risk, I think that's a time when equity makes a lot of sense. It's unfortunately not where a lot of impact equity investment is happening, but that's the traditional startup model. You get in early, and you have a share of that upside. As things become more predictable, this is where debt, I think, becomes a key tool.
Yes, absolutely. But you know, exactly what you've said, debt is probably the most universal tool. We like to think of it as the plumbing, you know, of the entire enterprise, and it can play together with grants. So we're taught, you know, whether they're government grants, philanthropy. So we really take this approach that absolutely it doesn't have to be all debt. It can be a combination or blended deals, as we call it. And I think the starting point, certainly from Sefa, and I'd say many other social lenders, impact investors with a debt perspective, it's all about that responsible lending approach. So you want to set up for growth or resilience. You don't want to be a burden. If we already know that there's no likelihood of getting repayment, you know, we're not going to put in a loan. It has to be there for highly customized with the organization. And I'd say because we are a long-term partner and debt investment sometimes is over, you know, a number of years rather than a short-term grant, we build that, you know, very personal relationship. And I think I was in a session earlier around, you know, the lessons learned from a social enterprise. We at Sefa, yes, we are the second brain, but yes, we are absolutely the critical friend. We'll come in there asking you all the tough questions like on your business, you know, and I can feel for that. We are at Sefa constantly running a business, being in the business, but really taking that helicopter view about your business as in, you know, the business model, what works, what doesn't, what's the worst case scenario, what, you know, what does it actually mean to scale and grow? What does it do to your P&L? So asking all these questions, that's what we do in partnership with the organization to actually get to a point where, you know, we know what the debt will do within your organization. So, you know, we talked about like this, there's a difference between actually bidding for the Olympics and actually hosting the Olympics. Probably all the hard work's actually in that pre-phase around setting up the infrastructure. Yes, the celebration is absolutely great, but having that infrastructure in place will actually serve you really well, whether you take on debt or not. So actually sometimes what we discover is that you might actually need less debt because you've worked a lot more around, you know, the operating model, business development, and all of a sudden you are able to secure better contracts, better revenue, or you've decided, oh, actually we want to set up a new entity, you know, that is more of a profit for purpose and therefore we need equity. So I think asking all these hard questions and using an independent view as input, you know, to sort of go through that process, that's where we think a lot of the value lies.
That's right. So I think the key thing when thinking about your enterprise is there a piece of predictability that you believe you could sell to a debt investor? The whole future doesn't have to be predictable, but there needs to be a piece that feels predictable enough, that you're confident enough about, that it makes sense for a debt investment, that it's lower risk, because debt investment is lower return than equity investment. You know, equity investment often is looking for, you know, it's a chunk of the company and the hope is that the company might turn into something large. That's a very major investment. You know, that classic people looking for 100x return, maybe not 100x, but at least 10x return, or at least the potential thereof. Whereas a debt investment might be a 10% return annually over a few years. So obviously the risk needs to correspondingly be lower. And so characteristics of things that are low risk is where you have contracts in place. So, you know, there's a couple of kind of key scenarios we've seen on LendForGood. LendForGood's a syndication platform for debt investment. So we partner with people like Sefa who do have the relationships with the enterprises and are doing the due diligence, and they endorse enterprise on the site. So it's very different from my previous platform in the sense that as a founder or an enterprise, you can't just come to the platform and build your own campaign. That's both to provide that reassurance to the lenders that your claims have been vetted, that someone who hopefully has a good understanding of the industry that you're in, someone who knows you personally and has a high level of trust with you personally has checked it. But it's also to help you. There's stuff that Hanah's talking about. The people often don't know kind of when is the right moment to have debt, how much debt, what is the risk that might put onto the company, and how to balance that in terms of their own model and future objectives. So requiring that endorsement from an intermediary or partner like Sefa ensures that there's been also that support for the enterprise to really think strategically about, should this be a debt investment? Should we be trying to go for equity? Should we be trying to get some philanthropy? Could we blend them all together? in an interesting way to fund different pieces. So one thing we see a lot is when people need to add equipment or vehicles, any depreciating asset, essentially. And we see this is where we see a lot of people get stuck. 13 years of helping people launch at StartSomeGood, we've seen a lot of them kind of get stuck at this next stage. And it's often that they're doing something and they're working as hard as they can, and they might be selling all of it, but it's only enough to stay in business, never enough to build up a surplus to enable them to make investments in their own business. So maybe they just need a machine that costs $50,000, and that would make them 50% more efficient. But it's really hard to find that $50,000, especially when you're spending 110% of normal working hours just kind of maintaining the business as is. And so being able to get ahead of that, get that money up front and then pay it off through the increased uplift in the business. So that's a piece of predictability. You're already selling everything. You could probably sell 50% more. If you could make 50% more for the same cost, you could even lower your prices perhaps and sell more. Another is when people are moving to a new location. So there's been some setup costs. You've got a model that is location by location, and having set up once or maybe twice, you've now got kind of a model that you believe is pretty robust that says if we have X dollars and 3 years, say, we can set up in a new location and get to the point where it's sustainable and can pay back that loan. And the third is business models that are themselves based on, there's a lot of business models, particularly in the developing world, servicing the base of the pyramid. So people living on only a few dollars a day. And often the only way to help them adopt new and less environmentally impactful technologies is to lend it to them. In other words, for them to pay it off progressively over time through their saved power costs or their saved biodiesel costs in moving to solar. They can't afford to just buy solar infrastructure up front. That, of course, though, creates a challenge for the enterprise because now they have to raise a bunch of capital to buy the solar stoves, to hand them out and to be paid back progressively. So again, overlaying, that's essentially a debt model that they're lending out electric motorbikes or electric or solar stoves or whatever the case might be. And then to be able to turn that operating capital into, upfront capital into operating capital paid off progressively.
Yeah, I mean, ultimately, all that debt does is bring cash flow forward, right? That's all it does. It's actually very, in a way, quite simple. And I think there's a lot of times, obviously, sometimes it does come with string attached, but in terms of influence on your business, is obviously very different to taking on impact, equity investment. So we, as a lender, you would definitely have a lot more of a hands-off approach, but it obviously comes down to validating the likelihood of that cash coming in, because that's the most important part, certainly from a debt perspective, to be able to repay the amount that you've been loaned. I know, and there was some notion around how costly debt is, especially in the smaller ticket sizes, and that's my strong personal view. If you are borrowing 100,000, if you pay 5%, or 10% on that loan. So whether you are repaying an additional $5,000 or $10,000 of interest, if that makes or breaks your business model, you should have never taken on a loan in the first place. It's really around your and the lender's risk appetite. The 100,000 that you're putting in, is it being put in for the right reason? Does it actually propel the business forward in terms of, does it generate directly new revenue opportunities, new sales, so that you can generate the cash, right, to later on then repay the loan. And it's interesting, moving into this, like, what does actually debt do to you as a business? We've actually got many borrowers or, executives of organizations, we've lent to, that have said it actually instills a certain amount of business discipline. I'm tracking my impact. Absolutely, I also want to track my business performance, right? I'm not going to be a sustainable social enterprise if I don't have a viable model. And I remember there was one founder who initially, coming out of acquittal processes with government, setting up a social enterprise, was aiming for black zero at the end as a budget or, next sort of annual projections. And, after some time, we said as a business, you want to aim for a surplus because you want to be able to reinvest and have some buffer for rainy days. And it's interesting, 12 months in or 6 months in, that very founder was actually tracking what, her available free cash balance, and just having that mindset shift in an organization around how they think about financial performance, that it's not a bad thing, to make a profit because you can actually reinvest it into the mission. But what are the management reports, the performance indicators? What are the things that will actually tell you that you're on track? And then how do these indicators actually relate to the impact? Because ideally, you want to have a business model, and that's really the crux of the analysis. How does capital propel your business forward while still unlocking and maximizing your impact potential? So we see a lot of value, actually, this experiencing debt and living with it in a way to actually then, manage your business on a day-to-day basis.
So we do want to give time for you. We could just keep bouncing off each other and sharing stories and examples and so on. So that's the fallback option, but we also want to give, I think we're going to get about another 10 minutes, if that to go. If there's anyone in the room who would be brave enough even to share, has a question about whether your enterprise is at the right stage where debt would make sense, or if you don't want to, share anything specific, just any generalized question about the role of debt, or yeah, right over here. We have a mic coming to you.
Yeah, because we don't charge any interest for just having a conversation.
Hi, Dev here, actually ironically from Westpac. The question I had was, how are you guys pricing the risk, and also what kind of analysis are you doing on the businesses and in pricing that risk when you lend out to these businesses?
Yeah, sure. I'm happy to take that question. So from a Sefa perspective,
Okay, do you want to repeat
yeah.
the question?
Oh, that's true. Actually, the question was, how do we decide on pricing? Probably also from a risk perspective. And then how do we undertake analysis or due diligence on organizations? To the first question, we're obviously operating different to banks. So actually, our business model is relatively simple, that our cost of capital is slightly higher. So from a minimum interest cost, we are currently sitting probably at the 8.5, high 8s. But then vice versa, we are not going to be as expensive as venture debt fund or, I guess private lenders in terms of that maximum. So we are probably maxing out around sort of 15, 16% in terms of the high risk loans that we are writing. And we maintain that spread sort of 8.5 to 16% to actually be fair to borrowers, different stages, different security for a loan. So we want to make sure that even within that relatively small margin, because yes, we want to be a sustainable business, but also at the same time not be too expensive, because ultimately our purpose is to unlock social impact. So we are operating in a much sort of smaller margin and trying to, as I said, maintain that sort of fair distribution across the portfolio. And in terms of the due diligence process, I'd say it's really involved, but I feel also very collaborative. So it's all about, asking some of those questions, like the tough questions as a critical friend. But at the same time, a lot of times you also come in with ideas and say like, well, you're wanting to, let's say borrow for 100% of your project. We think you can only afford to take on a loan for 60. How about together we approach, for example, a couple of foundations who could be interested? So we are trying also to be the solutionists and work with you to set you up for success. And obviously, as part of that, we are going through a framework that probably has like 10 buckets of, risk factors or elements like management team, board, super important. Ultimately, we are lending to people, not just a legal structure. Business model, stakeholder market. We're obviously looking at cash flow. We are considering security. So it's actually quite involved. I would personally probably say we've got a much more detailed understanding of our borrowers than probably a traditional bank, because we don't work with a checklist approach. It's really a conversation and exchange, and it sometimes can take time depending on how large the amount is or how complex the transaction is, pulling it all together.
So one of the things that I guess we've designed LendForGood around is understanding how much of this work is already happening, that there is so much due diligence happening in our ecosystem. And that cost of due diligence is in fact a big reason why those smaller deals don't get done. Because the way in which funds operate is they invest a lot in fundraising, which is an embedded cost that needs to be paid back. And then they invest an enormous amount in making very careful decisions and running really robust processes to decide. And often they look at, I met a fund earlier this year who does 2,000 robust due diligence processes each year to make 10 investments. What a lot of founders and enterprises don't think about is you have to pay for all of those. Your returns. You can't just, the returns on investing in you can't just pay for due diligence on you. It has to pay for 200 due diligence processes, plus the cost of fundraising, plus the cost of administrating the funds and everything that goes into that. So that's one of the reasons, that's a structural reason why small deals don't happen. The reason we think concessionary deals don't happen is because there is a lack of granularity or specificity that links people to the stuff they care about. It's a little bit like, imagine if the way that charity happened was you had to give money to Charity Inc. And they would then distribute the funds to charities that they thought were good. Maybe at most you could give a very broad thematic, but often not even that. Naturally, if you might think, I'm still happy to do that because, it's better than if I'm going to get them the same returns anyway, why wouldn't I do that? But that's a very rational, very emotionless thing. What we really want people doing, obviously, is really expressing their passions through some of their investment decisions. And we know that when you link that, people are open to different returns. It doesn't have to be commercial. And you see that, for instance, on equity crowdfunding. It's harder to read there, but that's highly concessionary capital hidden in the form of the valuation. That the valuations that people are earning on equity crowdfunding platforms are much higher than they could earn from professional investors. No professional investor would take those valuations. They would want twice as many shares for their money. Individual investors largely don't care. Some people might say that's a product of not being sophisticated enough to know what they're doing, but it's actually a product that they're doing something different. They're not doing investment, they're doing impact making through investment. And we think that's really, really different. And that's why the whole sector spends a lot of time trying to convince investors to care about impact. Our belief is there's all these people who care about impact, let them invest. But then how do you know what's worth your investment or not? And that's where it's not about disintermediating that due diligence work. It's not about saying it doesn't matter. It's about, could we get more out of it? So we think due diligence is like food. There's plenty of food in the world, and the reason that hunger persists is it's poorly distributed and often wasted. And that's exactly the same with due diligence. It's poorly distributed and often wasted. So by partnering with people like Sefa, 17 so far have signed onto our platform so that they're able to publish and share their due diligence, enables the rest of us to follow. Because we think there's a lot more people who would be up for following once we know what the specifics are. Once it's no longer just invest in a social enterprise, it's support this female founder of a circular economy fishing startup out of Indonesia who's doing amazing work. You're like, well, I spent some time in Indonesia and I really love supporting female founders, so I'm in. It's the specifics that often hook us in. You don't need to care about impact investing. If you care about refugees, if you care about clean oceans, if you care about circular economy, if you care about having a livable environment in the future, well then investing is a way that you can support those sorts of outcomes. And once you've got that connection, people are a lot more open-minded about what return is right for them. Because just as like impacts are very personal, like what really matters to you more than the others, everyone's got very different and often an overlay. There's an issue, there's a location. I'm really into circular economy, but if it's from WA as well, I'm extra interested because I'm from WA. There's particular overlays of things. And funds just don't get granular enough. There's not an impact investment fund out there for circular economy startups from Western Australia, particularly if founded by an Indigenous person. They normally only have one layer of specificity, but we're a stack of things. And so ditto with risk, ditto. And so once again, we didn't want to invent our own definition of what is appropriate returns and say it's this or that, but rather we hope to just have a really wide spread, all the way from 0% perhaps, up to highly commercial. Some are multi-year and patient. We've had loans as short as 3 months. Sometimes people just need to service a contract and they can pay it back in 3 months. So yeah, we think there's a whole range of what might make sense to people. Investors often have very particular dynamics that they're familiar with and comfortable with, but the rest of us can be, if we want to be, more open-minded about what constitutes a fair return or a fair balance of risk.
I think we just got the signal from our timekeeper that we've got time for one more question. So, oh, great. Otherwise, the second one can obviously come after we finish the... Sure.
Couldn't tell if you're pointing to me or behind me. So you've mentioned blended capital a few times, and obviously that means you consider how to play in the space of debt not being the only thing on the table at that time. So how do you view that landscape when you're interacting with an organisation? Where do you want to have been approached in that journey? First, second, at the same time? It's obviously like it requires a lot of investment to be playing that landscape as a founder or a CEO and trying to figure out where the money's going to come from. Do I keep putting energy into grants? Do I keep talking to all the other options, or do I come straight to the debt solution? So how do you help facilitate that process, and where do you want to play in that space so that we can put our energy into the right?
Yeah, sure. No, really good question. So I think from our perspective, obviously, I'm not saying that debt is limitless, but obviously if we think there's an ability to provide debt, we're providing between 200,000 and 2 million. We've arranged sort of syndicated loans, as we call it, in, partnership with other lenders of up to 6.5 million, whereas they always say philanthropic dollar is the most precious dollar in Australia. So this question of like, how much potentially debt can you carry? So if you've got an option in terms of securing already a large part of your stack or your pie, depending on how you look at it, And then, yes, you know, together we will probably decide like, you know, we can only fund 50% because that'll be, you know, the responsible approach, also stress testing for, you know, worst case scenarios or potential interest rate increases. And then ideally, if there's then an option to provide, you know, to apply for other government grants, we can provide letters of support or approach philanthropy together. But of course, if there's already an existing relationship between the organization and philanthropy, it probably expedites the process. From my personal experience, it's really important to have partners on the table who just get your, what I call impact alpha, who just absolutely get your purpose and, you know, the essence of why you exist, who are absolutely in a way in love with your impact, because that at least gets them to the table to have the conversation. How can a grant work? And then, for example, what we found quite powerful is for example, Sefa to share our due diligence with other funders, you know, to your point around not replicating due diligence. Obviously, we can't provide personal financial advice, but it might give the, you know, philanthropist comfort that it would be a one-off grant investment that is there to effectively be the equity. But then once that investment has been made, you know, the business model is off to a good start. But then a lot of times it can be reiterative. So putting all the puzzle pieces together, and obviously the more cooks you've got in the kitchen takes time. Sometimes approval timelines take a lot of time. So I'd say overall, a blended deal or having different funders is always going to be more complex and, you know, long term, but it could potentially be just the perfectly right solution in terms of the capital stack for the organization. So from that perspective, it's worthwhile.
You probably don't want to hinge everything on everything work coming together. I think it's the other thing, like, you know, just being careful with all the conditionality on that, you know, the equity investment can only be completed if the debt investment is also completed, and vice versa. Obviously means you end up with all of it or none of it. The dynamic we see a lot is equity first, then debt. Because equity to you know, high risk, experimental, maybe based on a certain invention or science, it funds the MVP. That's working. Now we want to double production. That's debt. That's a time to do debt. You know, that now demand is outstripping supply. We need to invest in scaling up our production. Don't sell more chunks of the company to do that. That's when debt becomes relevant. So one of the things we've done again is trying to leverage the due diligence already done. People often see these as completely different pathways. Like I raised equity from you and I want to raise debt from Hanah, so I just have to start from scratch with Hanah. But we're partnered with a couple of early stage equity investors in Southeast Asia, particularly like Radical Fund, who are making kind of angel equity investments into companies. And they're then endorsing them to raise debt on our platform. And for a lot of people, you know, the due diligence they've done to make that higher risk, longer term equity investment, that's a sufficient proof point for me to make a shorter term, lower risk loan kind of against that without having to start the due diligence process from scratch. But I normally see it in that order.
Well, I think thank you so much. We are out of time.
Here if anyone wants to chat.
A little bit of demystifying debt, and obviously if there's any additional questions, feel free to grab us now or later during the lunch break. So yeah.
Thanks, everyone.